for sure.
Great, and then
everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're going
creators
mainstream.
to the person who's collecting trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Yelp Goes Mainstream podcast. Today's episode is with an experienced professional responsible for growing the footprint of one of the largest private markets businesses in the industry. We sat down at Goldman Sachs' 200 West office to discuss the evolution of the firm's work with the wealth channel and how an intensified focus on private markets is helping to drive their strategic imperatives in asset and wealth management. Kyle is a managing director, global head of alternatives third-party wealth at Goldman Sachs, which has over $500 billion of AUM in private markets. Kyle is responsible for the distribution of both Goldman Sachs private markets products and third-party products to the third-party wealth channel. Kyle and I had a fascinating conversation about the most pressing trends and questions in private markets. We discussed how lessons learned from traditional asset management have helped Goldman with their private markets business, the benefits of a broad platform when it comes to helping the wealth channel navigate private markets, why advisors should integrate private market solutions, how to build a wealth channel business, how to think about evergreen funds versus closed-end funds, the next innovation in productization, why co-investments are becoming in demand for the wealth channel, and are evergreen funds here to stay. Thanks, Kyle, for coming on the show to share your wisdom and expertise.
We're going mainstream.
This episode of the Yelp Goes Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts Going Mainstream. Welcome to the Yelp Goes Mainstream podcast.
Thank you. Welcome to Goldman Sachs.
Thank you. No, it's great to be here in the studio. I think that's actually something that's emblematic of one of the most important aspects of private markets, which is education. And Goldman's been a big part of that in terms of not just markets, but in general. So the studio is a nice setting to do this in.
It's nice to have you, and it's a little bit of a welcome home, isn't it?
It is. Yeah. I was here at Goldman before. From a technology perspective, people were really investing in private markets. Now, obviously, Goldman's a big investor in iCapital, amongst others. And that's honestly one of the things that I'd love to discuss in this conversation is how the technology innovation in private markets, market infrastructure is impacting how you think about things on the distribution side and how you work with the wealth channel, how the wealth channel can actually invest in private markets. But first, would love to start with your background. You've been at Goldman for a number of years.
Yeah.
You've worked with the wealth channel in a few different ways. So would love to hear your journey and how that's then interacted with what you're doing.
I've been in wealth alternatives for more than 15 years, and it has always been an exciting corner of the market because it's the biggest pool of capital, it's the least allocated to alternative investments, and it's the fastest growing pool of capital. So if you rewind back 10 or 15 years, it was always exciting for that reason. I think why we're at sort of a new, exciting inflection point is you have a lot of innovation on structures. You have what we think a growing market opportunity for alternatives. And you also have a little bit of change of paradigm of what it takes to be a very successful GP and what clients are looking for.
I would love to hear what it means to be a complete partner.
I think it's a huge privilege to step into the wealth alternative space at Goldman Sachs because we have this unique perspective, we have this unique heritage, 150 years of operating. We've been investing in private markets for 40 plus years. Our first buyouts were in 1986. We've been investing in private credit since 1996, although it feels like a recent topic, right? So we bring this heritage with us, which gives us a really good perspective on the market. And that is the sort of thing that clients really demand. And that's experience and being a thought partner on not only what strategy or what fund might be suitable for a certain market or a certain goal or outcome a client's looking for, but they want somebody who can be a thought partner. And if you can leverage unique insights from global investment research, if you're us, we've got 3,000 investment bankers covering every region, every sector. That gives us a really great base to talk to clients about markets and macro, talk to clients about asset allocation, talk to clients about this alternative asset class versus that alternative asset class. And so in some ways, it's energizing for us to have these conversations with clients because we have such a unique perspective on education.
How does having a perspective on public markets, understanding how different regions of the world are thinking about things, where opportunities are in investing, how does that help as you think about how to work with the wealth channel on private market solutions?
As an asset management business, have this really unique combination of a highly scaled and successful public markets business and a highly scaled and successful private markets business, $500 billion. And those are complementary because, to your point, increasingly clients want, like I said, a partner who's going to help them think about their exposure across the asset classes, not cabin privates and then, talk about publics. It's what kind of credit risk might we want to take across both of those. And to be in the unique position to be able to draw from such mature businesses and businesses that are standing on the shoulders of Goldman Sachs operating in 45 offices is something that's really appealing to clients.
When I hear that this is really a consultative sale. You have to help people understand how they should think about asset allocation broadly. You have to educate them on not just why privates, but why privates where in a portfolio. What are some of the lessons that you've learned from working with the institutional segment, and how have you applied that to the wealth channel? Because you've had a long history of working with the institutional side on both traditional and private markets.
It's a insight that we draw on all the time, which is from client bases that have been well allocated to privates for a lot of different market cycles. Lessons are learned. How diversified you are, what you might choose to do from a diversified fund perspective, a co-investment perspective, primaries versus secondaries, how many asset classes you really want to introduce into your portfolio based on the goals that you have, right? Do you have a yield objective? A lot of individuals do. It's centered to a lot of the conversations that we have. How do you achieve that in a sort of risk-adjusted way? And living through a lot of those cycles with institutional clients, our own wealth clients, and frankly, our employees as aligned investors gives us that base to be able to bring those lessons learned on portfolio construction, what themes to focus on, what themes not to focus on. And I think it just gives us a huge leg up in the sort of dialogue we can have with wealth investors.
You talk about the different vantage points you have. The institutional side, you have your own wealth clients within PWM. You have your own employees, many of whom have invested alongside other clients into private markets, products that GS has offered. What were the foundational principles that you took from working with those constituents that you've brought to working with a third-party wealth channel when you started the third-party wealth channel business?
We're really focused on the quality of the investment flow. So all of the investment capabilities that exist at the firm across asset classes and alternatives, we bring all of that to bear without exception to the strategies that we're working with wealthy clients on. And we care deeply about that. And so the best investment ideas that exist within the firm and alternatives are going to our wealthy clients, just the same that they're going to our institutional clients. And so we care a lot about that. And we have, we're fortunate in what we can draw from there. We care a lot about structure, terms, and fees, right? We're very deliberate about the sorts of structures that we choose and what asset classes should be in certain structures. It's an industry-wide question, but I think we think quite deeply about the asset and liability match. And we make hard decisions on that. And we think really through the lens of this being a long-term successful investment for the client. So we care deeply about that. And then the other is a little bit more broad-based, which is just making sure that we are bringing all of Goldman Sachs to every product, every education touch point, every engagement and event we have with a client. We're afforded a lot of advantages, whether it's the network, the history we've been investing in all these asset classes. And if you're an investor in a Goldman Sachs alternative, you should feel all of that accruing to your advantage. And so we work tirelessly to make sure that all the investment talent, all the investment opportunities structured in a really useful way for individuals, is the experience. And that's a really energizing thing.
You've had third-party RIA business and traditional asset management. You have an RIA custody business. You're really trying to serve the wealth channel writ large, whether it's for Goldman clients or more open architecture. Mm-hmm. What does the third-party wealth channel want that's different from the way you'd serve clients that are within the Goldman confines?
In some ways, they want the same thing. And some of them were the qualities that I was describing. They want the most high quality investment opportunities in every corner of the firm. They want a really efficient structure. They want really advantaged terms and pricing. They want to see every resource that Goldman Sachs has to offer. That kind of transcends client segments, the ultra high net worth, single family office, down to the mass affluent. That's what they want in return. So we're delivering all of that across the segments. Now, it can be very specific beyond that. For certain mass affluent investors, you might be choosing different structures where the eligibility point is different, the mix is different. You might have an inclination to have more of a multi-strategy approach. You might want to marry the public and private approaches to investing more neatly together. Whereas the highest end of the segment might have a higher desire for single asset co-investing. Their balance between evergreen and drawdown might be slightly different. And so we have the tools to face all of those client segments in a very specific way. And that excites us a lot. And then from an advice and guidance, and like I said, the partnership as a thought leader, some of those segments might want to work with us more fully to draw from our CIOs or augment their CIOs or rely on us for model delivery or tools. And we might have some partners that are truly just looking for investment strategies, depending on the segment. So I think we work in a very fragmented channel of capital. And if you're not arriving at all of those segments with something that's very suited for them, with all of those same common philosophies in mind, you're sort of missing it.
How do you think about segmenting the wealth channel in that context and making sure that you're serving different constituents within the wealth channel in different ways? Because they all have different needs, different client sizes, different solutions required.
We have the tools to work with all of those segments. This is a channel that people segment in different ways. So you certainly have wirehouses, global financial institutions, private banks that have been investing in this space for a long time, who often have their own voice with CIO or center of influence. And there are some ways that we'll work with them that are very strategy-based or fund-based, and where maybe there's a big foundation of investing in alternatives. And again, a lot of consistency, though, in terms of what they might want from us in education and what they're expecting in terms of the institutional quality and all of that. But then, look, we might think about especially in the US, the RIA market is extremely exciting. Every single day, we're thinking about how we work more closely with the RIA community. And so the RIA community, the independent broker-dealer community, there are a lot of different styles and sizes and preferences across all of those, and a lot of different underlying clients. And it's really one of one. And I know that it sounds like it's a harder task to go address the market one of one, but we fight to do that.
That quote kind of brings up shades of the family office community when the quote, one family office, one family office.
Yeah.
That must make it really hard, though, to think about how you actually serve that channel then from a delivery perspective and a coverage perspective? How do you think about then creating and setting up a team to make sure that each firm gets what they want? Because I think you're hitting on a really important point, which is we've now reached the point of firms want customization and differentiation.
Definitely.
They have to do it at scale.
Yeah.
And so different firms have different sizes, so obviously that means different things for them. But how do you make sure you're creating that customized solution and experience for them while also making sure you're meeting the scale requirements?
I really think they are all one of one. So how do you go accomplish that task? I think for starters, it's really hard if you don't have genuine depth across a lot of asset classes. You have to have the toolbox to pull from. You have to have all these things that we've talked about, which is to be like a true thought partner, genuinely unique insight. That's what you're drawing from. But in terms of coverage and depth of relationship, we feel strongly that all channels, all regions, feet on the ground, genuine relationships with all of these partners we have across all these channels is the only real way to understand what of all these, abundant resources at Goldman you can draw for their benefit.
On that point, how much do you leverage the existing relationships that you have? Because in many of these cases, you've probably had boots on the ground for traditional asset management product sales. So there's been some sort of RIA or wealth channel coverage or across private banks in different regions of the world. How much is that an advantage? Because I think we've seen this in private markets. There's only a select set of firms that have the ability to put the boots on the ground and spend in private markets, whereas a global bank and platform has the ability to do that because they may have had those relationships in the past. But then the other side of it is, how do you convert those relationships? That's not easy either. So how do you think about that balance of those two things?
It's a great question. That's right. Look, we think that's a huge advantage for us, and it's certainly shown that it is. So we have this great combination of having generalists that engage with the wealth channel across all sorts of solutions, from public to SMAs to privates. And the partnership between the generalists and the alternative specialists is quite tight. Of course, it takes constant attention to make sure that that's happening in chorus. But what that yields is this kind of decades-long depth of relationship, but a really, really high-quality engagement with an alternative specialist that is living every day and week in what is happening in private markets. And that's a really compelling thing.
What do you think is more important at this stage in terms of building relationships with the wealth channel and effectively offering investment solutions to them? Is it having distribution professionals who have the long-standing relationships but maybe haven't had a background working in or distributing private markets products? Or is it the alternative specialists who really understand private markets, and they can then, as the door may be open because you have the relationship with the firm, but then they come in and they're the ones who are spending time talking with the firms. As you think about constructing a distribution team, is there a way in which you think about that?
We see them as complementary because the depth of relationship of that generalist is not in place of somebody being able to be really articulate about what are often a lot of complex things that are playing out in private markets. Now, the other way around, being really in tune with where the market opportunity is and isn't, and how Goldman is approaching that private market opportunity is not a replacement for 2 decades of a relationship. So each serve a really important role. We believe firmly that that partnership is super effective. Now, I will say, because we have more solutions and alternatives, particularly for wealth, than we ever have, we really are growing substantially in terms of those domain experts that complement generalists. And that goes for the US across regions, that goes for the Americas, ex-US, that goes for Asia Pac, and that goes for EMEA. So for us, it's an exciting global opportunity. Like, there are common threads across all those geographies, and we're hitting on a lot of them. And so when we think about how excited we are to sort of show the world this legacy and heritage we have in alternatives, we're building a team that faces that market globally.
You mentioned the words legacy and heritage. The other word that comes to mind is brand. On that point, how much do you think brand helps with building those relationships and making sure that you're able to get in the door? Because people know who Goldman Sachs is. Now you can talk to them about private markets.
We are really proud of our brand, and we're really proud of our company. And the way that plays out is often it's met with a lot of trust, a safe pair of hands, a partner that's lived through cycles, a partner that's frankly been a big part of growing some of these alternative market strategies from the very beginning. And it's also a huge advantage in how we can traffic globally, because we work in 45 offices globally at Goldman Sachs across divisions. All of those things that are so unique about us really tie back to our brand, and that accrues to the benefit of the client.
From a different perspective, because we talked about the need to customize for the wealth channel, and that's different for different types of investors in the wealth channel, but some might want open architecture. Mm-hmm. How do you think about balancing the Goldman products that you create versus having third-party products on the platform and working with other firms as well?
We embrace it. It's part of our history too, and it's an advantage because of our $500 billion plus in private markets, a big piece of that is Goldman-led direct private investing. A big piece of that is open architecture. So our XIG business, our external investment group, is a huge advantage. So when we're able to speak to clients, we have a lot of objectivity, because it's not just a Goldman-led strategy. It can be a multi-manager strategy that we've created for that client. It can be a secondary strategy. It can be a co-investment strategy. It can be a GP stake strategy. And that is a huge advantage. And it also gives us a real trained eye to how others are investing, or risks that others are taking, or what we think the optimal operating model is.
Given that we're to some extent in the middle of an arms race in private markets for firms trying to work with the biggest platforms, private banks, and on the independent wealth side, is that relationship with these third-party managers changing? On one hand, my mind goes to, yes, they want distribution through all different channels. Mm-hmm. On the other hand, you're a formidable player in alts. You have over 500 billion of assets. That would put you within the top 10 of managers, both pure play alternative asset managers and also traditional managers. So is there a bit of a tension in that regard?
Top 5, not that we're paying close attention to that, but you know what? It really does not. Look, I think there's healthy competition. We work together in a lot of different ways, whether it's being an open architecture investment platform as another source of capital. These are not new relationships for us as an organization. These are relationships where we've earned a lot of trust with our competitors and managers that we choose to allocate capital to. And in a lot of ways, we're sort of a natural port of call for that relationship, right? We have a great legacy in being a secondary buyer. You look at the liquidity landscape of the last 3 or 4 years with more continuation vehicles, more GP-led transactions. We're a great home for that. We're an effective partner in that way. That's just one example of the kind of depth we have of those relationships. There's certainly competition, but it's healthy and those relationships are deep, and it certainly doesn't distract from the work that we're doing.
I imagine it also gives you the flexibility to do some really interesting things on the product creation side. So I want to get into that, because I think that we're at a really interesting place in private markets where there's a lot happening in that regard. How do you think about innovation in product creation as it pertains to, you can leverage Goldman products, you can leverage open architecture products, you can create multi-manager products.
Public and private.
Yep. How do you think about all of that? What do you think is what's next in this space and the next big innovation there?
It's a great question, and it is reaching a fever pitch in the industry. And look, on one hand, we have at our disposal all that raw material that you just described, which we're really fortunate to have, right? So there are very few things that we can't do when it comes to combining asset classes, combining public and private, choosing structures. So afforded that, we debate a lot. What are the right strategies? We choose not to do some strategies based on the asset class or based on, where those wrappers are in their evolution. We think the emergence of more evergreen alternatives is here to stay. It's going to grow substantially from where it is today. It's appealing to a wide set of investors. That's sort of the interesting thing. In one way, we talk a lot about it's a better access point or it's a lower eligibility. But, some of those qualities like, fully funded, having 100-cent dollars invested into the market, transparent portfolios, those are qualities an institution might want too. So the interesting byproduct of some of this evolution is, yes, it is very helpful for wealth investors. It's very helpful for all investors.
On that point, are you finding that it's enhancing the franchise in terms of the ability to serve institutional clients now?
It's interesting because it's certainly not either or. These structures, we're of the belief that this is more flexibility. This is more ways to express whether you want to invest in alternatives or what kind of alternatives. And look, we're seeing it appeal to all client segments. Institutions, we're definitely seeing a lot of discussion in how retirement might use these vehicles as well. All channels and segments of wealth. So it's almost in an incidental way, a lot of this evolution is accrued to benefit all clients globally, which is why we have a firm belief that it's here to stay. And it's not, it's not one superior to the other. It's sort of, what are you looking for?
What's interesting there, if you think about some of the trends in private markets broadly, institutions have culled a lot of their relationships. So they've shrunk the number of GPs they want to work with. Now we have this explosion of new product, particularly on the evergreen side. When you think about the wealth channel, do you think that they're going to want less relationships or more? And what I'm getting at there a bit is, do you think we'll start to see more multi-manager vehicles where they'll have a single solution? Mm-hmm. Or do they want to be able to pick and choose it from a few different solutions, but have the agency to do that?
I think that there will be a strong desire for fewer partners, but partners that have a wide breadth of capability and a long history in those, and a lot of resource, and partners that are complete partners that can couple solutions with insight and network and convening power and creativity. I think all of those things that make for a high quality partner are becoming quite obvious now. And I think there isn't a long list of partners that have all of those qualities. So I definitely think there will perhaps be fewer partners, more scaled, and investors are going to be demanding of all of those qualities. And we're frankly very excited to be one of those people that has that range. But then on the implementation, I think it's a slightly different answer, where it doesn't necessarily mean that the preference for the strategy or the wrapper is going to be all asset classes or all things or all geographies. I think it might actually be the other way around, where you might be a multi-capability manager with global reach and a long history and the right education and all of that, but you may be asked by your partner to give more customization. You might have the core diversified strategy. You might be asked more so for co-investment flow. You might be asked more so to be helpful in delivering this exposure through models. So I actually think it will be perhaps fewer partners, but the ask of those partners is going to be more substantial, and not everybody's prepared for that.
On that point, where do you draw the line and say there are certain things that may not be great for the end client in the construction of certain products, or maybe just because they want it doesn't mean they should have it? And I think this gets to some of the research that you've put out and white papers that you've written around. There's a sliding scale of using evergreens, using closed-end funds, and there's no one right answer. But how do you think about that balance of those two things?
Maybe this is reflective of our ethos and our long-term view of client relationships. But I think two things. I think one, it goes first to the question of who should be investing in alternatives. We're not necessarily believers that everybody, period, should be investing in alternatives. There are a lot of reasons, even if you're a sophisticated size investor, where you are in your life, where you are in your education on this, what your desired outcomes are. We're not of the belief that full stop every individual. So I think that's slightly different than some of the marketplace. We think a big swath of individuals should be utilizing alternatives. But I just make the point first that some people are not necessarily positioned either by size or by where they are on their interest, their outcome, or their sophistication to do it. But then what vehicles should exist, what strategies should exist? We have a point of view that asset liability matters a lot, and frequency of liquidity matters a lot when it comes to how accurately can you really value those assets. And that's always been a key topic, but it's something we care deeply about. And the validity of that is something that we're keenly interested in spending time on. And so when it comes to the ability for investors to be able to not have an asset liability match that doesn't make sense, or not have valuation that doesn't make sense, we just think that there are perhaps some strategies that you don't want to do in certain structures.
So that brings up a really interesting point, because you mentioned earlier that I started my career here on the principal strategic investments team. Now it's GS Growth. They invest a lot in market structure as part of what they do. iCapital, 73 Strings, another example.
Yeah.
I think that the technology innovation in private markets, market structure can't be decoupled from the distribution side. If you could sit down and talk with the team at GS Growth that's investing in the likes of iCapital or 73 Strings, from a distribution perspective and being in the field with advisors, what are the things that you think are still missing from a technology perspective that you'd love to see be built?
Definitely. Wow. And look, it's an exciting time because there is such progress being made across so many of these like friction points. The things that we're really excited about that are improving are definitely the ability to use alternative strategies in more ways. And when I say that, I mean not just single strategy investments, but model delivery. Models that are entirely alternatives, models that are alternatives as a slice of an entire implementation. I think that is really exciting. And not only is that a really good investment solution, but that is also very easy for financial advisors to do. And it's professionally sort of often centralized how that portfolio construction happens, which is a real benefit to the end client. So I think a lot of the technology for that sort of delivery excites us a lot. The other one is a little bit less technical. It's a little bit the frequency of communication, how we're orienting ourselves to provide transparency into what you've already invested in, frequent market and macro, tools to be delivered into your client book, all of that reaching more frequent, higher quality, more ways to use, like that as a accelerant or a partner to the solution itself. There's a lot of technology that's making that a reality.
What's really interesting about that is I think you're kind of putting a bunch of different pieces of the puzzle together. Like there's the UMA and SMA concept, which happened in public markets, that's now happening in private markets. And that requires partnership with a bunch of different people to make that happen. There's aspects of helping people understand reporting, valuations, education, but that's also getting to something that you as a firm are focused on, which is things like lending solutions. Like there's all these different pieces of the puzzle. What do you think are some of the pieces of the puzzle that are going to become more and more prominent over the coming years as private markets becomes part of the holistic solution for a client's portfolio in the wealth channel?
You make a really important point, which is the post-sale. We care deeply about that. There's a lot of energy of what's the right solution, how do you balance the benefits of some of these funds or strategy solutions to one another. But once you've made the investment is perhaps the most important moment when it comes to transparency. Is your valuation correct? What kind of education partnership, what kind of insight from markets and macro can you provide? Like over-indexing to what happens when you are an investor and the post-sale is something that we're spending a lot of time on. And I think when it comes to the technology or the evolution and what the investor experience is, frankly, is improving tremendously. And I think that's going to contribute a lot to the adoption in wealth alternatives. And look, it's something we're very awake to. We want that post-investment experience to be world-class. And I think that's just going to be a growing area of interest.
How do you make that world-class?
I think you have very rich content and you provide it frequently. You provide it to the client level. You provide it to the financial advisor in the home office level. You engage on a direct basis across a lot of different mediums. You meet people where they are, recorded, live, in person. A lot of optionality when it comes to sharing the outcomes of these investments with people is really the name of the game. And I think that is just something that investors are beginning to demand.
You mentioned something really interesting, which I thought was fascinating. You mentioned the end client before mentioning the advisor. Not that the advisor is not important. They are critical in that process. But in private markets, I think one of the themes, and this is why I bring it up in this context, is because you're seeing firms realize they have to showcase who they are and educate and show their brand to the end consumer.
Yeah, definitely.
I imagine we talked about brand a little bit earlier, but I'd love for you to dive a little bit deeper on this, because the value of brand and marketing to the end consumer, it feels like with what the likes of Blackstone have done with their marketing efforts, et cetera, is that this is very much a consumer-driven marketing strategy here, and needs to be if you want to educate the end client.
Definitely.
That helps them think about private markets with their advisor. So how do you think about all of that?
It's a great point. And look, we'll always work with our partners and our financial advisors exactly how they want us to work with them, right? In terms of the level of direct engagement or the format of the content or education or reporting that they want. Like we'll always start there, of course, because everybody wants to engage a little bit differently. But the importance of making sure that clients receive the depth and the richness of market insights, reporting, performance, hearing directly from business leaders that are making decisions about the investment that they made, being treated with the kind of high touch that perhaps in institutions used to being treated, is becoming the standard. And so we are very focused on delivering that to the client for all those reasons. One, because it gives this great depth of relationship and this trust and this kind of enduring engagement with a client, but it helps with brand recognition, right? It helps bring to life the good and unique investing that's happening on their behalf. And I think that trend is going to grow. Again, like I said, it's a balance, because with respect and at direction of your partner or your financial advisor. But I think that's something that is going to be ever present, which is going to be engaging the end client.
It's interesting to think about the evolution of this on the third party wealth side. Because if you think about within Goldman's PWM business, you launched a business like Apex because there was demand from the ultra high net worth investor cohort to have access to co-invest or sports investment opportunities, really interesting, unique, kind of off the run opportunities. And a lot of firms have thought, okay, how do we serve this client type in the way that they want to meet them? I think, as you said, meet them where they are. How do you think some of the lessons learned from that effort will be ported over to the third party wealth channel over time, as maybe people want access to single investments or more interesting or niche investment strategies, in addition to the traditional kind of core private markets exposure they should have?
There is success to leverage there in a lot of different ways. And that's a fantastic business of ours that we're very, very proud of. And I mean, look, the richness of engagement, the feeling all of these unique advantages at Goldman that are accruing to your benefit, but really doing that, whether it's in person or it's, customized reporting, or it's listening enough to understand that you need to call that partner on an investment opportunity that they've been keen on, that's like quite unique. It's all of that kind of depth and commitment to the relationship that I see coming out of that business is so appealing. It's probably the customization, and again, that's obviously a dilemma, right? Because you can't endlessly customize. You need scale too. But for certain partners, we go back to like, how do we think about the wealth segment? And the groups within that are very different from one another. There's a big group in there that will demand customization. You should be ready to prepare that for them. And so there are a lot of things that we learn off of that.
How do you go about and educate advisors effectively? You did this personally before building out the third party wealth channel business. You did this with Goldman's advisors. You're now doing it with the third party wealth channel. How do you effectively educate these groups on private markets? What do they need to know? They can't spend all day doing this. So where do you separate the signal from the noise?
I think one part of it is the insight itself that you're actually sharing. And I'll come back to that. The other part of it is how are you delivering that? So the insight itself, I do think, look, it's great for wealth alternatives writ large that there's more education and there's a lot of focus and spend and attention, and that is great for the end client. It's great for adoption, all of that. But I do think perhaps it could get saturated, and unless you're providing something that is very novel or you are a business that's fortunate enough to have a genuinely different insight. We operate in all these businesses. We have for so long. We have all this history and track record experience of investing. What we deliver to clients when it comes to insight and markets and macro and asset allocation is on the back of all of that. So it's quite novel. That is going to be very obvious, I think, in the future, who has very novel insight and who doesn't. So I think the insight itself is one part of it. I think the other part of it is how are you delivering it? And not to give a simple answer, but it really is everything. Every medium, short form, long form, every region and translation, in person, collateral, and online, right? We have spent a lot of time on our education platform. In April of this year, we're going to roll out Goldman Sachs Investment University, which is going to be one medium that you can access all of this, and it's going to sit in a centralized place with a lot of different content.
So I think that's a really interesting point, that you have this educational platform. Others have or are rolling out these types of initiatives as well. I think it's critically important for the space. How do you make sure you separate yourself from others building educational platforms? Because there's only so much content that people can consume. So
Definitely.
how do you think about really adding value to this space?
I think it's harnessing the truly unique insight that exists at Goldman Sachs. And we have, I would argue, one of the best education engines in the world because of who we are. But actually packaging different insight, which we do and will do, it's doing it in a way that's highly customizable. I don't want emails every day. I'm the type of person that wants to listen to one recorded markets and macro, or one update to how to choose a vehicle at the end of the month, or I don't want any of the online content. I actually just want to know when you're convening people in the city that I live in, or, you know, things like that, where you take all these bits of education and make them highly customizable. I think that's just very, very important. And then I think, look, the third thing, look, every client's going to want to consume this differently, but I think in general, clients and advisors, there's no replacement for in-person engagement, at least as an option. So making, in our case, this GSIU come to life and be able to come live it and hear it and experience it is something that we're really keen on, because the investment platform that you can access online and all that insight is very interesting. And that might be the way that most people want to access it. But I do think making it three-dimensional and attaching it to events and all that sort of stuff is going to be a really key part in breaking through some of the noise.
I think that's really interesting to think about what resonates, what doesn't. Where my mind goes with that is, if you look at some of the evolutions of other asset classes or products like ETFs or mutual funds, what are some of the lessons you think you can learn from how those products ended up becoming more mainstream and helped educate, and how firms help educate investors on how to work with those? You think there's a lot of lessons you can apply and will take to do the same in private markets, or do you think it'll be very different?
I think in some ways it'll be similar, in some ways it'll be different. Look, I think ways that it will be similar is really leaning in on education. I mean, we're talking about it, doing all these things, and really over-indexing to how much time and repetition it really takes to understand what are complex asset classes and dynamic markets, right? So I think a real recognition that education is going to lead. I also think that performance in some way is going to contribute to how quickly adoption is going to happen, or whether people are going to stick around. And I know that is like painfully obvious, right? But it really is. What is the proposition? I think you've learned the asset class, you're participating. Like, the proposition that ETF has given you in the last 10 years is quite interesting, and that's long lasting. And so in alternatives, and everybody's going to approach how they think about making sure that return premium is maintained or that diversification is maintained. But that is going to be a huge deciding factor, as well as that like education curve everybody's on. If you are getting in return a decent return premium, diversification, some like ballast to some of the volatility, then you're making good on that, right? And so that's where I begin to think about like what we've lived through in the last 15 years in ETFs and how we're seeing it play out in alternatives. I just, and look, we think deeply about this. We make no compromise on how we create product, what size should that strategy be in terms of maintaining that premium, because that's what's going to drive the long-lasting adoption.
What do you think is the, maybe without giving anything away that you don't want to give away from an educational perspective, but you talk with a lot of clients, what do you think is the next frontier for education that people want to learn about or want to hear more about?
I think that tools, like useful real life applications for a lot of the insight, honestly, that we put together and others put together. The insight itself can be novel, as I was describing, if you're fortunate enough to have these perspectives or lived in these markets for long enough. But I will say, taking all of that and providing application to partners where, you know, a portfolio optimizer, something where you can toggle asset classes, things like that, tools are just going to be very important. And it really gets to the heart of, you know, where you were going with how technology has removed some of these points of friction, has really advanced the adoption. Tools for advisors to use in real life, in addition to the really useful recorded quarterly update or something like that. I just think that is a whole nother domain that is just increasingly important.
On that point, where are we in the development of helping advisors truly understand how private markets impact the rest of a portfolio or its asset allocation? So with things like, how does it impact volatility? At what point in time in a market cycle should people be investing in a certain product or strategy? Mm-hmm. Where are we in the development of that? And then as a sub question to that, where are we in the customization of that?
I think if we're honest with ourselves, we're very early on being able to show advisors and clients, you know, what the utility and impact of batting. It's not easy by any means, but I do think we're at the very beginning of meeting that need of pro forma on a portfolio where I to allocate 5% to private credit. I'm just, you know, no particular number. We as an industry don't do a really great job of doing that and doing it at scale. And I really do think that is a need, and it's a way to take the utility of this asset class and really make it practical for somebody's portfolio. So I think we're at the very, very beginning there. And don't get me wrong, there are people that are making huge advancements. There are great tools. That sort of goes back to my comment. I really think that improving on that unmet need is going to be a huge thing because it brings it to life. And then inherent in that is a lot of customization. Every client is thinking about, look, you know, there might be top of house strategic asset allocation, but every client's going to think about that differently, and they're going to want to toggle the tool for implementation and what that means for their investment outcome in an entirely different way.
Well, you look in a different category, but something like direct indexing, right? How impactful that is for people to be able to customize the types of securities they might want to invest in. Yeah. Imagine if you could get there with private markets, because I think what you're getting at is people understand the why of private markets. Now, I think there's been enough education of, okay, private markets can add this to a portfolio, or you should have some exposure here, and here's why. But then it's the so what, and how do you help advisors really touch and feel that so they can understand, if I invest in this fund, this is what this does. Mm-hmm.
Yeah, it's what does it mean for me though, right? Like I get the utility, there's a premium return perhaps, or depending on what asset class, it's a more defensive, diversified thing. But what does it mean for me in my real life? If you can't show a few exhibits or tools to help you figure out a few different versions of what an implementation plan looks like, it's really hard to go from the conceptual to adoption. And so we are thinking a lot about that. And we think that providing more tools for that, perhaps even some looking back in history, right? Like what would have a portfolio done during COVID? What would have a portfolio done in 2008 were you to have 10% to private credit or 10% to private real estate, whatever? There's value in that. But I think what does it mean for me, taking it from the, I understand it, I kind of know what this is now, to what does it mean for my portfolio and the risk I want to take and the return I need in return for that is an entirely different thing that's unmet.
A slightly more personal take on this, but what's the so what for you? Why do you do this? Why are you so excited about private markets?
I think private markets is more exciting every year. It just is. I think a few examples, like the period of time that a typical private company stays private is extended. It extends even further every year. The truth to value that can be created in a control investment like a buyout is proven time and time again. I think what's going on in credit markets that we all talk a lot about, this convergence of like where's the financing happening in private markets increasingly, public markets, and that line's getting a little blurred. I think the recognition of private credit is unbelievable. I think some asset classes or sub-asset classes that weren't always so accessible, infrastructure. Talk about a classic asset class, at least core infrastructure, that was like very long duration, not necessarily in wrappers that individuals could access. A lot of innovation being had to be able to have a fully invested infrastructure portfolio with some sort of liquidity. That's not entirely another asset class that an individual can invest. So there's all these things that are occurring every year. And then like, look, just forget about the asset class. It's just themes, like all of these themes that we all spend time thinking about and talking about: artificial intelligence, advances in healthcare, energy transition, how the liquidity in the market is affecting secondaries. That is largely playing out in private markets. And so that is really exciting. So I feel fortunate to be spending so much time in private markets, because every single year there's like another lurch forward in how much of all of this that we spend our lives talking about is in private markets.
On that point, looking forward, what are the things that you're hearing from advisors as to what they're really interested in right now?
I think probably tax advantaged. This is not a new topic, but I do think some innovation in what strategies GPs can provide to help contribute to that conversation. Exchange funds, a lot of different varieties. I think that's not surprising at all, but that for taxable clients, I think the realization that there are actually a lot of interesting strategies and solutions that you can layer in that are private market solutions for tax sensitive clients. Yield alternatives remain, right? I do think there's a recognition of, where the reference rate is, the lines being redrawn on public and private credit. And so I think that still, though that topic has reached a fever pitch in the last year or two, is still perhaps the first topic that everybody's talking about. I do think, not surprising either, maybe liquidity, just in general, in a lot of different ways, in getting the money returned to me that I invested, in taking advantage of the illiquidity through secondaries, or give me a bilateral way of stepping out of one position I have in my portfolio, like a proper, healthy secondary market. So I think that's a topic that will persist. It's not surprising that it is a topic now based on the rate cycle and where liquidity's been. But I think those are all things that everyone's talking about. And I think, to bring it back to a point I made, that's sort of why you don't want to be a single topic partner, right? You want to be somebody who has insight across all those things. You want to be somebody who has insight across those topics in different geographies. And so that's why I sort of made the comment that being that kind of thought partner is the dream.
I'm asking this question to a scaled platform, but it does feel like scale really matters in private markets.
It definitely does. And there's a lot of more specific strategy examples of that. Being a scaled partner in secondaries makes you a more effective buyer, perhaps makes you a little bit more effective at being able to assign value. Like there are strategy reasons. Same goes for credit, being a lender of choice or a speedy, reliable source of capital and execution. There are a lot of reasons why some of those strategies are better if you're a large scaled incumbent. But I think through the eyes of a client, the degree of trust that a track record across multiple asset classes or having lived through some of the push and pull of markets across more than one discipline is really valuable.
That's a great way to bring everything full circle. I like to ask every guest, and this is your personal view, you don't have to ascribe this to Goldman Sachs, but going forward, I think it's such an interesting landscape in private markets, so many different product innovations, different strategies that are now accessible to the wealth channel. What is in your view, is the asset class or strategy you're most excited about going forward?
Wow. I think choosing between all of our children here in asset classes, look, maybe it's because of the illiquidity environment that we've been living through and are living through. And I think it's probably private equity secondaries. And I say private equity secondaries, but what I really mean is secondary markets across buyout, credit in some ways, hard assets and infrastructure. And because I think it's interesting how perhaps like a couple of years ago, some of the discussion was around how long are we going to stay in this moment where secondaries are key and discounts are wider or whatever. And I think we're all learning quickly there's almost this permanency to a scaled secondary market across all these asset classes. And again, some benefit accrues to the incumbent. And we've been investing, just take us for example, we've been investing in secondaries across those asset classes since 1998. So a permanent scaled secondary market is something that we get excited about, right? And clients that invest with us in secondaries, for example, get excited about. So I think it's not a theme or a company or, but it's something that I just think it's one of these paradigm shifts that's happening in alternatives.
I think that's a great way to tie everything back to the conversation you started by talking about the platform and the benefits of having global purview, scale, et cetera. All of that kind of is wrapped up in having a heritage business focused on secondaries as an example.
Absolutely right.
So,
yeah.
Kyle, it's great to have you on the show.
Thank you, Michael. I appreciate it.
Yeah. Thanks for coming on.
Thank you.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going